Let's get more on the yuan with Axel Merck. He is President and Chief Investment Officer at Merck Investments, author of Sustainable Wealth, and he correctly called the credit crisis as early as 2003 and helped position his clients to profit off that, or at least not to lose as much. Axel, thanks so much for joining us. Let me ask you, as soon as I started reading this news on Saturday morning, the first question that popped into my head is how much? How much is China going to let the yuan appreciate against the dollar? Is that the key question here?
I'm not so sure whether that's the key question. I think here, if we're trying to address how much, what you have to look at where we have come from, where we're heading to, and the Chinese have taken step by step towards a more open market. Now, they're not moving as fast as we would like them to go, but all of your coverage, everybody talks about the U.S. perspective. This is a Chinese story more than anything else. The Chinese are moving because of domestic inflationary pressures. They need to steer their massive economy, and a stronger one, coupled with higher real interest rates, is what China needs, both for the housing market, but also for these wage demands that we've seen in the news in recent months. A stronger one is part of that story, and China is ready for that. China is producing goods and services at the higher end of the value chain, meaning they have pricing power. They can afford to deal with a stronger currency, and now they're testing the waters, and they'll take it again a step at a time.
All right, right now I do also want to bring into this conversation Jim Rogers. He is a longtime China bull, chairman of Rogers Holdings. He's on the phone from Birmingham, Alabama. Jim, great to have you back with us. Axel Merck was just talking about his thoughts about the move out of China. Do you agree that China is ready for a stronger currency?
Oh, of course. They said in their press release they're going to have continued the policy that they started in 2005. Now, they did start a policy in 2005 of opening up the currency and letting it appreciate. They stopped for a couple of years. Although during those 2 years, they did continue to open it up. They let some of their neighbors trade in the renminbi instead of U.S. dollars. So it is a continuation. I hope that they're going to continue to let the currency find its own value in the currency markets. We'll find out.
Axel, what do you think the effect on currencies is? I think Jim, for example, was very bearish on the euro, but short term he likes it. I mean, does this change the whole picture in currencies?
Well, yes, but not so much with the euro. I think the major affected parties are the Asian neighbors, those countries who have a good chunk of their exports going over to China. That's Taiwan, Korea, Singapore, and also Australia and Japan. Those countries will be the greatest beneficiary of that policy. As you point out, though, China is exporting more to the Eurozone than to the U.S. right now. So that's becoming increasingly important. And by the way, the Chinese yuan has been appreciating versus the euro. So there isn't so much catch-up potential there. But versus the U.S. dollar, they're finally taking the steps. And they'll take it in their own steps in their own time.
Jim, what about the G20? Do you think this move was because of the upcoming G20 meeting?
Well, it certainly sort of stymies any criticism. When they get there and expecting criticism, they'll be able to say, guys, look, we're doing what you've asked. We're doing what we started 5 years ago. It's in the same procedure. Yes, it will calm people down. I don't think it'll calm down people like Chuck Schumer. Your correspondent before was talking about how the American policy has been good because they've been doing quiet diplomacy. Mm-hmm. That's garbage. I mean, Americans have been shrieking from the rafters. It's not quiet diplomacy. It might work better if there were quiet diplomacy instead of all this shrieking.
Well, Jim, do you think then the Chinese, what they're doing, this news that we got, is it in response to all of the pressure they're getting from the Obama administration and so on, or is it that they're just looking to really manage their own country, their own currency, their own economy?
I'm sure that the Chinese are going to do what's best for the Chinese, just as the Americans do and the Germans do and everybody else does. They do what's best for their own economy, or at least for their own politicians. This is good for China to open up their currency, and they're doing it. They do have some dislocations, some sort of bubbles developing within real estate, coastal real estate. They do have inflation, and this will help both of those situations if they let it work its course.
You know, Axel, let me ask you, obviously the administration wants to achieve at least closer to equilibrium as far as exporting with China and with some of the other low-cost BRIC countries, with Asia. Dan Alpert from Westwood Capital out with a note today says it's going to take a generation or generations for that to happen. This really won't move them closer, really, but politically it's the outcome that they want.
Well, it helps the politics of the day, but the U.S. should really be careful what it's wishing for. And the Chinese have pricing power. In the spring of 2008, we noticed that import prices were up dramatically. That means the Chinese could no longer pass on the higher cost of doing business. The same now, wage pressure is going up, the currency is getting stronger. That translates to higher import costs for the U.S. And so we're going to regret having called for that increase, but at the same time, it is a necessary step in the rebalancing of the economy. The Chinese need to do their part. What's in interest interest of their economy. But in the U.S., we're not going to be the beneficiary of a stronger yuan. I don't think our exports are going to surge towards China.
All right. So you don't think we'll be a beneficiary here, even though it's what we've been pushing for. Is that because the movement is going to be so slow? Do you think that's the problem?
Well, because we don't have so much to export anymore. We've already outsourced all the manufacturing over to China. That is now going to move towards some cheaper countries, from Mexico to the Philippines and the like. But we're not going to manufacture coat hangers to sell in the U.S. Obviously, there are some high-tech goods that we may want to export there. But generally speaking, what is important is that the Chinese consumer is getting ready to be stronger. And we don't do that by giving Chinese consumers credit cards. We do that by encouraging a Chinese middle class, by giving the Chinese a vision, and that's the change we need to see.
I want to get back to our round table. We're talking with Axel Merk, President and Chief Investment Officer at Merk Investments, as well as author of Sustainable Wealth. Also with us is Jim Rogers, a longtime China bull and chairman of Rogers Holdings. He joins us on the phone. So, Jim, let me toss it back out to you. I was going through some research. Back in May of last year, you made some comments about you own the Chinese yuan, that every chance you get, you buy it. I'm assuming you're continuing to buy it here.
Oh, yes. It's not that easy. It's not quite like picking up the phone and saying, buy me some Australian dollars. But when I can, I buy more renminbi.
Is it your favorite currency out there, or what is?
Well, it's my favorite in the sense that I'm pretty sure I'm going to make a fair amount of money over the years in this currency. So yes, but it's not my favorite in terms of liquidity or being able to do anything with it. But as a long-term investment, it's the one I'm the most certain of.
Axel, I'm assuming you feel the same way in your Asian currency fund. You hold about 40% yuan exposure there. Do you continue to buy it, or do you feel comfortable already at that level?
No, we'll continue to buy it, and at the same time, of course, because you can't take delivery of it, because there's those restrictions, what we focus is on the dynamics that are unleashed as the purchasing power in China increases. That obviously has ripple effects to other currencies that are more easily traded, that show greater dynamics. And so ultimately, a basket of Asian currencies is what we have advocated, but by all means, we do like the Chinese yuan very much.
What are the other currencies that feel the quickest or the biggest effects from this? I mean, Jim mentioned the Australian dollar. I'm assuming the Asian currencies, since they're just closest geographically and as far as trading partners, probably the most prevalent, have the biggest effect.
Yes, generally speaking, that's correct. The Korean won is mentioned most often. Having said that, Korea has many other dynamics influencing the Korean won, but the Malaysian ringgit, or if you look at Taiwan, all these neighboring countries have a great benefit from China appreciation. And even the yen, Japan has been reorienting its economy to cater to China as well. And so all of that region is a great beneficiary of the story of China finally getting its act together on the currency and retooling its economy towards a more domestic consumption.
Jim, it was kind of the shot heard around the world this morning. We definitely saw the Asian markets rally on the news out of China. You also saw the European markets. U.S. markets are running out of steam here as we get toward the closing bell. Is it right for investors to be so enthused about this news on the yuan?
Well, I was a little surprised at how enthusiastic markets were, because it's not that big a deal unless there's more to it than meets the eye. It's not going to solve any problems overnight. It is a big deal to the extent that if it prevents trade wars, if it does prevent currency wars, then yes, it's a big deal. But while that removes a negative, it's not that big a positive unless somebody knows something I don't know and something that wasn't said in the press release.
It does show confidence. The Chinese have confidence in their economy. Axel, you mentioned that. Does that mean you don't think we're going to see any more stimulus come out of China? Do you think we'll see any more measures to put the brakes on the growth?
I'm actually not so sure what that shows, that they have so much confidence in the economy. I think it shows that they're very scared of inflationary pressures. And at the same time, they're also scared that a stronger yuan will put a damper on their economic growth. So I wouldn't even be surprised if they enact another stimulus package to ensure that a stronger yuan is not going to hurt them. But we'll have to take this in strides, see whether this is just a tiny step or whether they're moving more towards a open Chinese economy. The one thing we shouldn't forget is that the Chinese have continued to foster their economy economy with infrastructure spending. They really need to do more to unleash the entrepreneurial spirit in China. And so if we see something in that direction, that would be a huge positive for the region. But for the time being, it's a small step that's been taken in the right direction, and that continues on the same footsteps that they've been on for a couple of years now.
You know, Jim, Axel mentioned, the potential for more stimulus out of China, and also how that they're scared of inflationary pressures. You're in and out of China all the time, or in and all, I should say, out of the Asian region. You agree?
Oh, yes, yes and no. They're doing things to calm down parts. They do have a bubble, a real estate bubble in urban coastal real estate, and they know it, and they're trying to calm it down. So that's gonna be a restraint and a constraint on the economy going forward. I suspect that they certainly don't want to throw the economy off too much, so they will try to do other things to offset. And this is one of the things that they can do to offset that, because this will, if it continues, pull down inflation to some extent.
All right. Hey, Jim, thanks for joining us today. Jim Rogers there, chairman of Rogers Holdings. We want to thank Axel Merck, also from Merck.